A midday pulse check revealed something unusual. The S&P 500 closed green despite headlines warning of economic warfare escalation from Washington. Capital isn't fleeing, it's rotating with surgical precision. The question is whether this discipline signals immunity building or fever coming on. The market has exhaled. VIX dropped 5.5% to 1513, the lowest reading in 2 weeks. Risk capital is returning after Friday's midday panic, when US indices dipped before recovering. SPDR led inflows by over $2 billion this week alone, with speculative allocators like ARKK jumping 3.5% as Bitcoin cleared $77,000. The data confirms what the headlines hide. Fear has been priced in already. High-yield credit is running hot, while duration remains cautious. HYGW gained 1.25%, while TLT retreated 0.33%. Investors are selective about leverage exposure, not fleeing it entirely. The consensus among the Canary community is that credit spreads haven't widened meaningfully, despite geopolitical headlines. Our metrics indicate capital prefers shorter duration high yield over long-term government bonds when inflation expectations spike unexpectedly. Fear products flatlined across the board. UVXY shed 2.33%. VIXY retreated 1.5%. The real economy metric is what matters. Russell 2000 gained 0.8%, while large caps only managed 0.4. Small cap rotation into value suggests institutional investors see opportunity in quality at reasonable prices rather than defensive retreats. Vital signs show stress has been contained to headlines, not trading flows. Gold jumped almost 2%, while crude oil stayed flat. Classic inflation hedge behavior without systemic panic. Consumer staples XLP gained 0.6% but aren't leading the charge. The engine sector split. SMH dipped 0.25% as earnings season creates uncertainty around semiconductor capex cycles, while IWM surged 0.7% on domestic manufacturing resilience. Our data indicates the economy is decoupling from headline volatility. Real production continues regardless of political noise. GLD outperformed TLT significantly, revealing a preference for hard assets over duration risk. This pattern mirrors 2018's inflation spike response, where portfolios protected themselves through commodity exposure rather than bond yields. XLP held steady but didn't lead. The data shows defensive positioning is tactical, not structural. Bond barely moved at 0.13%, confirming money markets are neutral to slightly bullish on rates despite economic warfare rhetoric. The portfolio stands as the hero, because it's demonstrating discipline when headlines scream for panic. The villain isn't inflation itself, but the uncertainty of geopolitical escalation timing, and today's data proves capital has developed immunity through selective rotation rather than systemic retreat. Gold and high-yield credit built shields, while small caps tested whether domestic demand can weather external storms. The Canary dashboard shows fever breaking. Volatility dropped, smart money rotated into quality at reasonable prices, and the real economy continues producing despite political theatre. The verdict is cautious optimism with tactical precision. Protect duration exposure, but maintain equity allocation through selective positioning. Capital has found its rhythm again,